Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global rate specialists, Giles Gale, head of European rate strategy, Blake Gwinn, head of US rate strategy, and Theo Chapsalis, head of UK rate strategy. Hi everyone, welcome back to another Bondcast. We're recording this fresh after the ECB on Thursday, so let's get straight into that. Over to you, Giles. What did we learn this week? I guess we always expected it to kind of be a bit of a placeholder meeting. It's a sort of mid-quarter meeting after a big meeting in March. Was it any more exciting than we were expecting, or not at all?
Well, we came in with nice low expectations, and I think that she managed to really undershoot those expectations significantly. It was possibly the dullest meeting that I can remember having listened to, and I've listened to a lot of ECB meetings. Listen, I mean, going back to your original question, what did we learn? Not a lot. I mean, I think we already knew that communication is a little bit of a problem, but it's particularly a problem, I suppose, when they don't really have a message. And I think that was really the main thing, that there was no message. They didn't, we're always taught not to take meetings and not speaking engagements unless you have a message. I guess that they can't really back out of their 6 weekly meetings at all. So listen, I mean, everything has just been deferred till June, and that is the end of it. And any pressure to prejudge whether they might reduce the purchase pacing in PEP or anything like that was firmly battered away, to be honest with you. So where are we left? I mean, I think that the main interesting things were there was a comment sort of buried halfway through where Lagarde said that they've increased their purchase pace to something like the pace that they had in July last year. And that could be a little bit telling. I mean, it's a little ambiguous, as you would expect, right? Because, I mean, do they really mean July, or do they mean the average of July and August or whatever? But we sort of inferred from that there might be a little bit of upside risk in the purchase pace over the next 6 weeks. And I don't think the market was really had that in mind as something it wanted to hear. And so that, I think, probably explains why we had the positive reaction halfway through. And I think it makes it probably a little less likely that this tipping point we've been talking about, where we perhaps shift from this bullish stance where we're expecting everything really just to be dominated by flows, which are pretty supportive, to something where we're trading a little bit more in line with the more rates bearish, economy bullish fundamentals. Maybe that's just been pushed a little bit. So I think that's really my main takeaway.
And she was a little bit more optimistic, I would say, than perhaps she was in March around the kind of medium-term outlook. Does that make you comfortable that this significantly higher purchase pace does step down in Q3, or do you think it's really kind of too hard to infer from anything what she was saying today? And like you say, that decision really has been pushed back till June.
Well, I think whatever you thought before, you can continue to think now. I mean, there was really no additional steer from Christine Lagarde today. What we previously thought was that they will step down somewhat from June, and I suppose maybe we need to start talking numbers. I'm not going to do that today, to be honest with you, but I do think that they will reduce their purchase pace from this sort of surge, which I think makes sense, given that we were really quite uncertain about what was going on with COVID, and what the timeline was for the recovery in Europe back in March. And I think it will look quite different in June. So I think it would make sense for them to reduce from there. But let's just see.
Okay, seems like a theme we're just going to have to monitor then, and doesn't bode for a hugely exciting conversation today. So with that, we'll leave the ECB there then. And we've had this bearish call, as we've spoken about a lot of times on the pod before, for 1% in 10-year yields. But actually, over the past kind of few weeks has been movement in the other direction in gilts. We've had, I imagine you can tell me otherwise, but with the moves that we've seen in treasuries, gilts have kind of followed, and we've had this rally. So what's been kind of going on there, and what's different now that makes you confident that we're still going to reach that 1% target?
Yeah, I think it has been a very exciting period in the UK market, and it has been exciting for different reasons. One is really because we've had puzzling market reactions, right? So we had that Thursday, the previous Thursday, not this one, when pretty much on the back of stronger US data, we saw a significant market rally and then a sell-off, and then we saw gilts very much following that. So definitely the UK market is being traded as a proxy to the US market, and the UK market did benefit from the UK market did follow the sell-off that we had in treasuries at the beginning of the year, but also the UK market had to follow in that rally. It has been a smaller, a sub 1%, a sub 1 beta, so it has not been, the rally in the UK has been smaller than in treasuries, but it did happen. There are other reasons also, and I think the other reasons are really one, that we expect on Friday, 23rd of April. So this will be tomorrow. So we do expect an announcement and potential revision to gilt issuance numbers. And this has made a lot of investors be hesitant and reduce some of their short positions. Some investors actually have gone long gilts on the back of that. So this is one. The other point is the change in the progress with regards to vaccinations. And the UK, from being the unambiguous winner, and from the UK being really at short gilts, from being the trade that everybody loved to have in terms of, a bearish position, well, that view definitely has been challenged. What makes us convinced, and why do we like that view? Well, we think that really fundamentally not much has changed. We may get a bit less gilt issuance, but still we talk about a fairly high pace. We still talk about a Bank of England that will taper later this year. So the May meeting is particularly important. If a tapering doesn't happen at the May meeting, then we'll probably talk about a sharper tapering at some point later. So I think tapering is likely to happen. And then it is still the market where fundamentals are looking good. We will be talking about higher inflation, and if we connect all those dots, the underlying story is not so bad. So what did we say in March, the beginning of March? Cut your exposure to half, but still target 1%. Well, the story is not really very different, but well, probably we may be at a point where we need to increase our bearish position.
Okay. And so just picking up on what you said there around, well, both around the Bank of England tapering and inflation too. We obviously, one of the data highlights this week in the UK was the inflation print on Wednesday. And that came in, I guess, pretty much in line with expectations in terms of the overall numbers. I think there were some surprises when we looked a bit at the breakdown that weren't as close to expectations as the kind of headline figures were. What's your take on that inflation print, and has that changed what you're thinking about the Bank of England in the next couple of weeks?
Yeah, absolutely. Inflation is quite a key component. I think inflation is the big theme everywhere, predominantly, I would say, in the UK and the US, because we will have higher inflation later this year. So what we saw was a consistent and a persistent a persistent weakness in food inflation. So this is something which it became more structural rather than just a blip. Now, is this important? Well, we've got a part of the whole basket that subtracts around 15 to 20 basis points from the whole index. So yeah, if it is significant. So food inflation is something which has been consistently weaker. Now, there's been a normalization in other items. What does it mean? Well, I think that it means that the move up that we will experience with regards to the inflation numbers may be a bit less muted than otherwise expected. And what we continue to see is a market where expectations of the actual inflation print continue to be higher than the realization. So this is something that we have experienced since the November print. So it has been 5 prints with an undershoot from the actual RPI number relative to what the market did expect heading into that RPI release. So it doesn't change our view. Well, I think that to some extent it makes a case of the BOE not being so hawkish. But for me, the bigger opportunity is really to be still short the UK inflation market and particularly the front end of the curve, because basically it is a very good carry trade position. You've got inflation that realizes a lot lower than where it is priced. You stay with the position, and as long as that takes place, you make money from being short.
Okay, so just, I guess, a bit more of a general question then, before we move over to Blake in the US. Aside from inflation, what are you watching as kind of big risks to UK investors right now?
So I guess politics will be one important factor, and we were used to marking gilts to political events back in 2019. 2019 was a very political year. To get the gilt view right, you had to follow politics. So this obviously did change in 2021 because Brexit is out of the picture. But we have elections in Scotland, and this will be a potential driver of some additional volatility. So this is one. Two, what happens with the Bank of England, and we know that member Haldane, it has been announced that he is leaving later this year. Who will replace him, and to what extent the composition of the BOE continues to be at the same level, because Haldane has been an advocate of a tighter monetary policy. So this was his stance at the latest meetings. And I would say any volatility that we have in the market. So because the market does expect this lower volatility regime to last. And if you speak to most investors, they will say that things are very dull, things are very boring, things do not shake. And this is usually the moment when things start to shake. So I think that volatility, that become volatility, could actually happen without necessarily much additional news.
That makes sense. Thanks, Theo. So over to you then, Blake. I've got some kind of bit more specific questions, I suppose, to ask you around refunding and also what's been going on in the front end this week. But before we get stuck into those, I just wanted to kind of check in with you around your outlook for treasuries from here. I know you, like us in Europe, have kind of been waiting to pull the trigger on that bearish view. Last week we spoke after we'd had that kind of confusing price action in treasuries following the really strong data and then the big rally. Are you any closer this week to kind of changing that view to being more outright bearish?
Yeah, we've gotten a little closer to the levels. If you read the pieces that we put out in print, we've highlighted a couple levels that we'd be looking at for various trades. And this week we had a little bit of a rally at the beginning of the week. It's been very quiet in the US. Fed is in the blackout period. We haven't had any major US data, kind of quiet on the political front. So things have been kind of chopping around. We did rally a little bit, pushing us closer to those levels. So I really do think it's getting close to that time when you start thinking about setting up those shorts. We just haven't pulled the trigger yet. Given that we haven't reached those levels that we were, we're highlighting, we're within a couple of basis points. So really hoping we can get there. I did want to take a look at some of the data coming out of Japan, the weekly bond buying figures, see if there's any kind of signs there that the demand from Japan's continuing, which is something that could continue to push yields a little bit lower, providing us better entry. Also just kind of getting past today's ECB meeting, earlier this week, kind of thinking, this is really a medium longer term view that we're thinking about with that bearish view. So, we're in no rush. And so kind of waiting until those events had passed to see, if we did end up getting a slightly better entries. But within the next days to weeks, it really looks like it's about time.
Okay, something we'll be watching then over the next few weeks. Okay, so like you said, it's been a fairly quiet week, the past week in the US. So I guess that gives us a chance to talk about things that we perhaps might not otherwise talk about on this pod. And one of those things is that the primary dealer survey, if that's what it's called, ahead of the May quarterly refunding announcement has been kind of distributed. And one of the questions on that survey that has, I guess, caused a little bit of a stir, or certainly caused investors' interest to be piqued, is around what they might do about 20-year supply. So can you kind of just give us a bit of background on that and why it's interesting and what your thoughts are around that?
Yeah, sure. And just a little bit of context around that survey. Treasury does this survey quarterly. There's a lot of regular questions on it about supply numbers, but every time they have kind of 2 or 3 special questions, that they include about specific topics. This is often where Treasury keys in on future changes. They kind of walk the market. They've used it in the past to kind of walk the market in a certain way. When they're going to roll out a new benchmark, for example, they have all the quarterly refunding surveys leading up to that ask questions specifically about that new benchmark and, should we do FRN? Should we do FRNs? Yes or no? And so it kind of leads the market to these decisions. Other times it's really just checking the temperature of markets. Really they have an interest in some things that are going on and they'd like a little more color on it. I think this probably tends more to the latter than the former, meaning I don't think that them asking a special question about 20-year supply is walking specifically to cuts. I think some of the market are taking it that way, or looking at this and saying, oh, this, Treasury may be heading into to cut 20-year supply at this quarterly refunding meeting coming up in 2 weeks. I think they're really just gauging interest. This is a new security. Keep in mind, it had its inaugural issue last May. So this is an infant in as far as Treasury terms. I mean, it's only got 4 CUSIPs. It's a very new security, and it had to. I mean, think about it. It had to get rolled out in one of the worst times. Treasury was seeing a huge surge in borrowing needs, and that got rolled out at just the wrong time. They increased supply in a way that they never would have done if they had rolled it out during a normal period. I mean, usually when you bring a new security to the market, you don't really change supply for a while until it builds a little bit of an ecosystem around that point in the curve. Corporates start issuing there, people start using it for hedging purposes, real money investors start adding it, getting comfortable adding it to their portfolios. This security never had that chance. It got ramped up very rapidly. And as such, it's traded very cheap to where you would expect it to trade relative. If you look at where 10s trade, if you look at where 30s trade, where you would expect it to trade is traded very cheap to those levels. So I think Treasury just wants to come out, take the temperature, see where markets are at, and then maybe we do head to cuts at some point in the future. But I really think that that's a story, that happens the next time they're looking at increases or decreases to the entire coupon stack. Maybe 20s are just, held back on any further increases, or they're exaggerated in any future cuts.
Okay, that makes sense. So when will we find out more about, when does this announcement come and we'll know more about it?
May 5th is the refunding announcement. It's probably, if I'm right, it's really that you won't hear anything. They won't announce a cut. They'll probably have some color in the statement about, this is the feedback we received, we're keeping an eye on it. There'll be some kind of language like that. Just one other thing to note, and this kind of ties back into some things we've talked about in prior weeks. We've also got some stuff going on with the Fed. They've actually talked about buying more of it. So we've kind of got these two sides. We're potentially looking at a cut to supply, and we're potentially looking at the Fed buying more. We did get a speech from Lori Logan since the last time we spoke, in which she said that there may be changes to the next monthly schedule for the Fed's purchase operations. So we're going to be looking at that May 5th for Treasury when we find out about supply, but we're also going to be looking at that next calendar release for the Fed's purchase schedule to see if maybe the Fed steps up their purchases of 20s, which is something I very much expect.
Okay, so seems like it could be an almost perfect storm then for the 20-year if we have supply cutting. If we have supply cutting, and then
I'm optimistic. Yeah.
Let's see. So May 5th is the key date.
I'm optimistic in 20s. Yeah.
All right, that's the key takeaway, and we'll definitely circle back to that on May 5th, or the pod around that date. So the other, I guess, interesting part of the curve, then moving from the long end to the very front end, is the kind of squeeze that we're seeing there, and that resulting in a high usage of the Fed's overnight facilities, which I guess is even more interesting in the context of a Fed meeting next week and what they might do about it. Can you just perhaps give us a bit of background on what's really going on there and what you think they might do about it?
Yeah, and keep in mind, I mean, for people that listen regularly to these podcasts, and this is a theme that we've been talking about. I mean, I wrote about this in the Year Ahead piece back in November. I mean, this is a theme that we all kind of knew was coming. Essentially, that there would be too much cash chasing too few very short-dated, essentially risk-free overnight or very short-dated instruments to invest it in. And that's something that's come to pass. We've seen reserves spike. Holdings in government money funds have gone up. A little bit of it's down the last week, but overall have been going up. Bank deposits have gone up. Just a lot of cash floating around in the front end, and the places that you can park that, bills, overnight repo, a lot of these kind of traditional parking places for liquidity, for corporates liquidity, for individuals liquidity, those are starting to dry up. We've seen cuts in bill supply, and every month, and this is something, again, we've talked about in previous podcasts, but every month the GSEs start collecting money from essentially mortgage payments. Before they pay those out to bondholders, they park them into repo markets. So it kind of squeezes everything else out once a month. That's happening right now. And that's why things are getting a little bit tight this week. We had some bill pay downs, but also this GSE cash is currently in the system, which is just kind of crowding out everything else. And we always see repo rates kind of decline during this week-long period. Notable now because we were already at very, very low levels. So it really kind of just turns up the crank a little bit more. And we've seen SOFR hold in so far. I mean, SOFR is the median of all the transactions. It's held in, at positive levels. But if you look at the distribution, the Fed gives us the first percentile, 25th percentile, they give us these kind of ranges of where SOFR is trading. And if you look at the lower percentile, we do see negative repo trading. So that's kind of picked up this week. I don't think it'll be enough to pull down the median so that we get a negative SOFR print, or that it starts to pull down the Fed funds rate. But if we do see that, in the next day or two, the GSE cash comes out at the end of this week. So really the time for this to happen is kind of closing. But if we were to see that, I think the chances of the Fed making an adjustment to their rate tools, the administered rates, IOER, the overnight RRP rate, there'd be a chance that they would increase those by 5 basis points. And the whole point of that is to just pull the whole front end rate complex back safely above zero, so that you don't get negative prints on some of these benchmarks. So there's been a lot of talk about whether the Fed will do that. I really think that's something that's much more likely to happen in June or July this year. We're going to see, because of the debt ceiling, we're likely to see some pretty big bill pay downs in June or July, which again just takes away more investment vehicles for this kind of front end cash. So it's just hitting this supply and demand imbalance even more. So I think June and July is probably more likely, but just something to keep an eye out. And I think some people are still looking at the Fed to maybe come in and do a preemptive adjustment to these administered rates next week.
And when we talk about the Fed making these adjustments, do they have to be at FOMC meetings? Does it have to be at those meetings, or can they do it inter-meeting as well if it starts?
No. Yeah, they've made it very clear that they will do this inter-meeting. I think the markets get kind of tied to this idea that it would happen at a Fed meeting. But if, let's say tomorrow we saw the Fed funds effective rate tick down to 5 basis points, right? I think there's a good chance the Fed could come the next day and make an adjustment to these levels. There's really no reason why this has to happen in the context of an FOMC meeting. And if anything, FOMC meetings are more about policy, the big policy stance. And they don't see this as a policy change. They're not hiking rates because of a change in their stance on the economy or the outlook. They're just doing this to make sure that the targeted rate stays inside of the band that they've set for it. So it's really just a mechanical, technical kind of thing. which means it doesn't have to happen at an FOMC meeting. But still, the markets seem to focus on FOMC meetings as the likely delivery for these things.
Yeah, I guess that's always kind of the way. Well, at least it gives us next week something, to watch out for in what is probably going to be otherwise a fairly uneventful FOMC. I think they might be battling the ECB for what can be the most uninteresting meeting. We'll see. I'm sure we'll discuss more about that next week anyway. So we'll leave it there for this week. Thank you all for joining me again, and we'll catch up next week. I hope you enjoyed this episode of Bondcast. Please do subscribe to our channel to get future episodes and like it, as this will help others to find it. We also encourage you to follow us on social media to get all our latest content. Speak to you again soon.